If you're making a good income and you're wondering why you don't feel wealthy, you're not alone. In fact, almost 50% of Americans making six figures still live paycheck to paycheck. It's so easy to get distracted by the latest get-rich-quick schemes, but what many people don't realize is that the secret to financial freedom is less about increasing your income and more about what you actually do with your income. So today, I'm going to share with you my 7-step blueprint to completely transform your finances in 6 months. Hi, I'm Dr. Shamim Nazir. I've been there, working long hours, making what most people would call a great income. But I also had expenses and debt and no real plan. So if you're in the same boat, how can you regain control over your finances? First, know where you stand. The first step is to get a baseline of your finances by calculating your net worth. Now, this is not always fun or comfortable, but it will give you valuable insight into where you are and what you need to do. A lot of us have a negative net worth at the start of our careers, especially if we have student loans. And if you just look at your paycheck and your credit worthiness, you might be lulled into thinking your finances are in great shape. But in reality, they're not. And the net worth calculation clears the fluff and gives you the bare truth. To calculate it, make a list of everything you own, all your assets, and everything you owe, your liabilities. Your assets would include income from all sources, like your brokerage accounts, retirement funds. All the values in these are your assets. Also, any real estate, like your home, if it's paid off. Now, you could use the equity in your home as an asset, but just be conservative and use the purchase price and not the market price to calculate that. And liabilities are all your debts, your mortgages, student loans, auto loans, and everything else that you owe. Now you subtract the total debt from your total assets and you have your net worth. And you want to check this number at least once a year to see how you're progressing. And the goal of all the following steps is going to be to increase this net worth figure. The next thing you can do is to tackle the liabilities on that list. Tackle your debt, especially high interest debt, is the greatest drag on your net worth. Interest on debt is a guaranteed cost, whereas investment returns or market appreciation of your home is uncertain. So reducing debt is often the smartest investment you can make. A recent US News survey found that 21% of Americans didn't know whether they had credit card debt and 30% didn't know how much interest they were paying. Don't let that be you. Take a complete debt inventory, write down every loan and credit card account with its current balance and its interest rate. Next, pay it off. There are two popular payoff strategies. First, the avalanche method. Pay off debt with the highest interest rate first while making minimum payments on the others. This approach saves the most money in interest over time. And the second method is the snowball method. Pay your smallest debt first, regardless of rate, and then move to the next smallest. This gives you a quick win and motivation as you eliminate debts one by one. Both methods work. Pick the one that will keep you motivated. Reducing your personal debt not only boosts your net worth, but it also relieves stress and opens up opportunities to invest and other things. Now, the next step is my favorite. We all get busy and it's easy to forget what we intended to do with our money. The best way to make sure you stick with your plan is to automate everything. Automating your bills, savings, and investing is the key to staying on track. I hope you're already automating your bills. This ensures you avoid late fees and high interest payments. And then you've got to automate savings. This is what financial experts call paying yourself first. You may not feel like you're getting paid if you can't spend, but this is the best gift you can give yourself. Treat savings like a bill. Set up automatic transfers through your employer or bank. Have a portion of each paycheck transferred into savings or investment accounts. You might split this between a high-yield savings account for emergencies and investment accounts for growth. When you invest, use a method like dollar cost averaging, in which you invest the same amount every month. You will in essence buy more shares when prices are low and buy fewer shares when prices are high. This ensures that you get the best average price per share. When your finances run on autopilot, you free up time and mental energy. Now, the next one is difficult. We've all waited a long time to live the good life, and we want to get that nice house, a nice car, and all that goes with it. Number 4 is to avoid big purchases. Avoid new purchases, especially those that require financing. And why? Because loans can undo your progress and add debt and high costs. Thomas J. Stanley, author of The Millionaire Next Door, famously observed, "Many people who live in expensive homes and drive luxury cars do not actually have much wealth." Now, if you're wondering how much to spend on a car, consider the guidelines suggested by Money Guide. Ideally, you should pay cash. And if you're financing, they suggest putting 20% down and paying off the car in 3 years and keeping that monthly payment below 8% of your income. Next is home buying. It used to be the surest path to wealth, but now costs are sky high. If you're shopping for a house, calculate carefully. Experts usually recommend keeping all housing expenses, which means mortgage principal, interest, property taxes, and insurance, to about 25 to 30% of your take-home pay. Not only will avoiding big purchases keep you out of debt, that extra cash can go into your investment accounts and build wealth. The next step is know your taxes. Taxes are often the largest single expense in most budgets, so it pays to minimize them. Taxes on middle to high income are hefty. The IRS collected over $1.6 trillion in individual income tax in 2020, with about 54% of that paid by taxpayers with an adjusted gross income between $100,000 to $1 million. And if you're in that bracket, which a lot of doctors are, each tax saving strategy is vital. First, you can max out your retirement accounts. For instance, in 2025, you can put up to $23,000 into your 401k and an extra $7,500 if you're over 50, and you can also add to a traditional Roth IRA. Contributing to these accounts either reduces your taxable income today or allows your savings to grow tax-free. And don't forget about HSAs and FSAs. The HSA, which is a health savings account, is a triple tax advantaged account. The contributions are tax deductible, the growth is tax-free, and the withdrawals are tax-free for medical expenses. You can also use 529s for college savings. These allow for tax-free growth and tax-free withdrawal if used for educational expenses. And next, make sure to take advantage of all the deductions and credits. Of course, there are the common deductions such as mortgage interest and charitable donations, but if you have your own business or medical practice, there are a lot of other expenses you can deduct, and it takes some discipline to keep records. I like to use QuickBooks to keep track of my expenses, and I know it's difficult, but it's going to pay off. Now the next one is everyone's least favorite, but it's important. Number 6 is budgeting. Commit to tracking and budgeting your expenses. Choose a method you like, whether it's a free budgeting app like Rocket Money, Mint, or Dave Ramsey's Every Dollar app, or even his old school envelope system. Key is consistency for at least 3 to 6 months. Once you log your spending, you'll discover the overlooked expenses in your budget. You might have forgotten subscriptions or streaming services, apps, memberships you no longer use, and until you actually look at where your money is going, you don't even know it's happening. The first time you budget, it might feel tedious, but by month 2 and 3, you'll start feeling empowered. Remember, you can't fix what you don't measure. By tracking for 6 months straight, you'll have the data to cut waste, reallocate funds, to invest in not only your retirement accounts, but yourself. How do you invest in yourself? Well, that brings us to the last step, creating multiple streams of income. Think about your interests and hobbies and invest in these. Learn more about them and develop them. Chances are there's something you know that can be of value to others. Perhaps you like scuba diving, cooking, or writing. Could you perhaps write a blog, teach a course, or write a book? It may not be immediately obvious, but explore these ideas and think about what you can create that others would buy. Having multiple streams of income will not only provide greater financial security, it will also give you a creative outlet and greater fulfillment. And you never know, it may evolve into a lucrative business that someday replaces your job. In summary, transforming your finances is doable. You just need a plan. I hope you found this 7-step plan helpful. Let me know your biggest wins or challenges in the comments below. And thanks for watching. See you next time.